A retired couple in 1994 ran out of money exactly on schedule, except the schedule said they shouldn't have. William Bengen, a financial planner from California, had just published research in the Journal of Financial Planning showing that a retiree could safely withdraw 4% of their portfolio each year, adjusted for inflation, and never go broke over a 30-year retirement. For 3 decades, that rule became the gold standard of retirement planning. Then the math stopped working. Bengen's original 1994 study used historical U.S. stock and bond returns from 1926 to 1992, a golden era of American economic expansion, post-war productivity booms, and interest rates that rewarded bond holders generously. The worst 30-year sequence in that data still left retirees solvent. But a 2021 paper from Morningstar Research Services, led by analyst Christine Bentz, ran the same model against projected forward returns and concluded that the safe withdrawal rate had dropped to somewhere between 3.3% and 3.8%, a difference that could mean $200,000 less in lifetime spending for a $1 million portfolio. To understand why the rule is breaking, you have to understand what Bengen was actually measuring. He wasn't calculating average returns. He was calculating sequence of returns risk. The order in which your gains and losses happen matters more than the average return itself. If you retire in 1999 and the market drops 40% in your first 3 years, as it did during the dot-com bust, you're selling shares at depressed prices to fund your living expenses. You lock in losses permanently. Even if the market fully recovers, your portfolio never does because you've already spent those shares. This is what researchers at Wade Pfau's Retirement Research Center at the American College of Financial Services call the retirement red zone. The 5 years before and 5 years after you stop working. A severe market downturn in that window can permanently impair a retirement plan that would have been perfectly safe under average conditions. Pfau's 2013 research, published in the Journal of Financial Planning, showed that retirees who experienced a 30% portfolio decline in their first year of retirement needed to reduce spending by roughly 19% permanently, just to maintain a 95% probability of not running out of money. So what do you do with this information? The first instinct is to save more. Push the portfolio to $1.5 million instead of $1 million, so that 4% still generates enough income. But research from Vanguard's Investment Strategy Group suggests that simply saving more doesn't solve the sequence risk problem. It delays it. A larger portfolio still suffers proportionally the same losses in a crash. And if you retire on the eve of a bear market, the math is still brutal. The more durable solution comes from a concept called bucket strategy, formalized by financial planner Harold Evensky in the 1980s, and later refined in academic work by Darrow Kirkpatrick of Can I Retire Yet? The idea is to divide your retirement assets into 3 buckets by time horizon. Bucket 1 holds 1 to 2 years of living expenses in cash or short-term bonds, money you can spend without ever touching equities. Bucket 2 holds bonds and conservative assets for years 3 through 10. Bucket 3 holds equities for years 10 and beyond. When the market drops, you draw from Bucket 1, give Bucket 3 time to recover, and refill Bucket 1 when equities rebound. You never sell stocks in a panic. The behavioral dimension of this strategy matters as much as the mathematical one. A 2019 study published in the Journal of Behavioral Finance, conducted by researchers at Stanford Center on Longevity, found that retirees who used a bucketing mental model reported significantly lower financial anxiety and were measurably less likely to sell equities during downturns than those using a total return approach, even when the portfolios were mathematically identical. The bucket strategy doesn't just protect your money, it protects your decision-making. But there's a deeper problem with any fixed withdrawal rule, and it's one that most retirement calculators ignore entirely: healthcare costs. Fidelity Investments' annual retiree healthcare cost estimate, released in 2023, projects that an average retired couple will need $315,000 in after-tax savings just to cover healthcare expenses, not including long-term care. That number has been growing at roughly twice the rate of general inflation for the past 2 decades. A plan built around 4% annual withdrawals from a $1 million portfolio generates $40,000 per year. After taxes and health care, discretionary income can evaporate. This is why researchers at Stanford's Longevity Center, in a 2022 report titled "Seeing Our Way to Financial Security in the Age of Increased Longevity," recommend that retirement planning shift from a fixed withdrawal rate model to what they call a dynamic spending strategy. Instead of withdrawing a fixed percentage adjusted for inflation each year, you recalculate your sustainable withdrawal rate every year based on current portfolio value, remaining life expectancy, and current market conditions. In years when the portfolio is up, you spend slightly more. In years when it's down, you trim spending by 5% to 10%. The volatility in spending is uncomfortable, but the probability of a catastrophic shortfall drops dramatically. Michael Kitzes, a financial planner and researcher who publishes extensively on retirement income, analyzed this approach in his 2015 research on the ratcheting safe withdrawal rate. His data showed that a dynamic strategy that simply allows spending to increase when the portfolio reaches 150% of its starting value, without ever reducing spending below the original rate, outperformed a fixed 4% strategy in 96% of historical scenarios. The retiree gets upside in good markets, without the catastrophic downside of a rigid plan in bad ones. There's one more variable the original Bengen study didn't model at all: longevity. Bengen assumed a 30-year retirement horizon. A couple retiring at 65 today has a 50% chance that at least one of them will live past 90. A 25-year horizon that stretches to 30 only if they're lucky. But actuarial data from the Society of Actuaries 2023, RP 2023, mortality tables shows that a 65-year-old male today has a 1 in 4 chance of living past 92. For women, it's past 94. Planning for 30 years may be 10 years short. When you recalculate the 4% rule over a 40-year horizon instead of 30, Using historical data from Robert Shiller's long-run equity database at Yale, the failure rate roughly doubles. A rule that failed in 5% of historical scenarios over 30 years fails in nearly 10% of scenarios over 40 years. That may sound small, but a 10% chance of running out of money at 85 is not an acceptable retirement plan. The honest conclusion from all of this research is not that retirement is impossible or that the 4% rule is useless. It's that the rule was always a starting point, not a destination. The financial planners who have studied this most carefully, from Bengen himself to Pfau to Kitz's, agree on the same core framework. Build a portfolio diversified across global equities and short-duration bonds. Use a dynamic spending strategy that responds to market conditions. Maintain a cash buffer that prevents panic selling. And plan for a retirement that may last 35 years, not 25. Delay Social Security to 70 if you can. Every year of delay increases your benefit by 8%. A guaranteed return no bond on the market can currently match. The 4% rule didn't fail because it was wrong. It failed because it was being used as a precision instrument when it was designed as a rough guide. The retirement income problem is ultimately a math problem with a behavioral solution. The numbers work if the person following them doesn't panic, doesn't overspend in the early years, and builds a structure that makes rational behavior the path of least resistance. Subscribe to Wealth Science for more research-backed financial insights every week.